joining us for our webinar today. My name is Clinton Johnson. I'm a Managing Director at Benchmark International's Apple office, which is our United States headquarters. I've been working in mergers and acquisitions since 1998. In the past, I've represented buyers, sellers, and even sold a business myself. Benchmark International here, of course, we represent only sellers. And our target audience for today, as with our client base, is owners of businesses in the lower middle markets and middle markets who are thinking about eventually exiting their business or looking for a strategic growth partner. With the series of webinars, I don't know how many of you were with us last time, but what we are trying to do here is we want to be a bit unconventional. And the way that we're going to be unconventional today is we're going to, rather than give you answers or data, the main purpose of the discussion today is to ask you questions. And they're not questions that we seek the answer to, because each of you will have your own answers to the question, and they will be unique to you and your business. So these are really a list of questions that we think would be good for you to jot down, and from time to time maybe keep them in your desk drawer. From time to time pull them out and walk yourself through the list and see if you still have the same answers as you had the year before or the quarter before. The way we came up with these questions, as we do with all of our webinars, we've got together a group of our management. In this case, it was our U.S. managers, and we designed this webinar specifically to be targeted at the United States. And said, if you wanted to think about the timing of selling your business, what questions would you ask yourself? And we kicked the ball around a bit, and we came up with kind of the top 10 that we thought would be a good amount to get through in the 1 hour that we're together. So before we dive in, I'll give you a little bit of administrative things here. On the right-hand side of your screen, you should see a small orange arrow. And if you click that, it'll pull open a little menu on the side where you can adjust volume and a few other things. But most importantly, towards the bottom, there's a little chat feature. And I plan to talk for 50 to 55 minutes and then answer questions for the last 5 to 10 minutes. And the chat box you see there is the best way to submit the questions. So I have Sam here with me, and he'll be fielding questions throughout the hour that we're together. If you have more of an individual question that's not for the general audience, feel free to send that to Sam, and he'll try to get you an answer or direct you to the right person. And if you have a question that is relevant to the whole audience, Sam will save that till the end, and then he'll ask the question to me. So don't save up your questions till the end. Go ahead and fire them off so you don't forget along the way. And with that, I think we've got our attendees up and ready to go. For those who joined late, let's dive into the data here. So as I said, we're going to present 10 questions to you. And when we were kind of throwing this around, we found that the questions were grouped into 3 different types of questions, or 3 areas of questions. And the top you see there on the top of the first one you see there on the top of the slide are the external factors, the things that are external to you and your business. And we came up with 4 questions there. And then on the bottom left-hand side, you see internal factors, meaning aspects of your business that would lead to some questions. And then on the bottom right-hand side, we see 3 family factors, or 3 questions we'll ask you about the family factors. And family can mean individual or personal or your larger family. So we tried to keep it 3, 3, and 3, but on those external factors, you really have to ask all 4 of those questions to have it make any sense. So we'll start off with 4, and we'll also kind of be starting with the more technical stuff. So getting through the first 4 will take more than half the time, and then when we get to those bottom 6 questions, are kind of a little softer, a little more simple. So it'll be a little bit heavy going in the beginning, but then it eases off as we go through the hour. So we'll start off with the external factors, and here we mean things that are external to your business, and they're also external to your control. And the way to think about the 4 questions, kind of the overriding rubric of them, is that Economics 101, the basic laws of supply and demand. And in this case, when we talk about supply, what we mean are the supply of businesses for sale at any given time. And when we talk about demand, we mean the demand for those businesses, or the number of buyers, or the amount of money that's chasing after those deals that's out on the market. So you see on the screen here all 4 of the questions there that have the round bullet points. There's there's 2 questions on each side, 2 supply, 2 demand. There's some more words on the demand side, but that's just because we put up a few more details. That's going to be a little bit longer discussion. But these are the first 4 questions. And so the first question, we'll start on the supply side with those 2 questions. The first one is about demographics. It would be nice if we could make decisions about our business in the complete absence of history and assume that all things external to the business will remain constant over time. But it's just not our reality, and we have to deal with the moment in time that we're here, and basically the hand that we're dealt in this regard. And the single largest factor that we believe should be weighed in your decision on timing is demographics. And this is, again, particularly focused at the United States. And the most important aspect of demographics is, of course, the baby boom generation. So the baby boomers are just about to come into the period of time when they would be expected to be exiting their business based on historical data about when owners of lower middle market and middle market businesses sell. So we're ahead of that curve at this point. And at the annual ACG conference, ACG is the Association for Corporate Growth. It's the largest group of buyers of businesses in the lower middle markets and middle markets. And so they have an annual conference that was in Las Vegas this year. It's attended by thousands of buyers and then people like us at Benchmark. And there was a specific seminar set up, roundtable set up to discuss demographics. And the one point that really hit at home, and it's really good because it's both mathematical and it's very simple, which is the best kind of math, says that if you start with the data that the average owner-operator owns a business for 25 years, and then you apply actuarial tables and census data, you see that what that means is that in the typical year, all things being equal, 3% of all businesses that are in the middle markets and below should come up for sale. That would be what you would expect, all things being equal. But then when you apply census data and you look particularly the baby boomer issue, what we see is that because of the aging of the owner base, that number is going to move from 3% up to 6 to 8%. And out of that growth, kind of the 3 to 5 or the 3 to 6 is due to the age bubble moving through. And then the extra 1 or 2% on the top of that is due to the fact that we did not see 3% of these businesses going up for sale coming out of the Great Recession. So for the last 8 years, that number was a bit lower than the 3%. And the demographics indicate that there's another 1% out there that decided to hold off on selling for one reason or another. So you're looking at a historical supply of 3% and coming at some time in the near future 6 to 8% based on just demographics alone. So again, this is the first question for you. How does this affect the timing of my decision to sell the business? And the second question we have there, which is closely linked to demographics, and I've already mentioned it once, is this Great Recession hangover. So last year, for the first 6 months of this year, Benchmark, the United States, we've sold 14 businesses. And so you get an idea for the quantity of financial data that we're looking at. And what we're seeing, again, I'm not going to give you the answer to this hangover, but I just give you some data for you to think about, is that companies' profitability is higher year-to-date in 2017 than it was at the same time in 2016. And the 2016 profitability numbers are generally higher than the company's 2015 numbers. And when we go back and look historically at their 2007 or 2008 numbers, we're seeing increasingly businesses have recouped the setbacks that they suffered during the Great Recession. We're not seeing a lot of businesses that have exceeded those numbers yet. But you have that pent-up demand by business owners who might have otherwise sold in 2009, 2011, 2013. Maybe some of those people are you who are listening and watching here today. And they elected not to sell because they know that the profitability or the funds that the sale is going to generate is tied extremely closely to their recent profitability, typically the trailing 12 months before the letter of intent is signed or the trailing 12 months before the purchase closes. And they said, you know, if I had sold in 2007, I could have made a lot more money, so I want to hold off until I can get those numbers back. So they held off, didn't sell, and as I presented the data, we're starting to be at the point now where businesses are generally getting back to those numbers. So we see this hangover effect from the Great Recession, and we see it wearing off slowly. And so the question for you here, our second out of our 10 questions, is what effect is this hangover from the Great Recession going to have on my decision to sell the business? And you know, how long will that hangover last? That's another, you know, kind of sub question for you. And what's the macro economy going to do to speed up or slow down that hangover effect? Again, we leave that up to you to ask yourself. But in terms of the supply, those are the two things that we think are the most important. We could list 5 or 6 more, but those are the two most important supply factors. And with that, we'll move over to the demand side of the equation. And this is where we'll have a little bit of a lengthier conversation. So the two questions there on demand, the first is the supply of money. And while I'm trying to present the question as neutral as possible, on this one, it's really hard to be neutral. We can still pose it as a question, but it's admittedly a non-neutral phrasing of the question. I think what you have to ask here is, will the supply of money ever be better than it is right now? So, again, not a neutral phrasing of the question. And that's why I'm going to spend a little more time and explain why, well, generally we want these to be open-ended questions for you to decide. This one, the facts are pretty strong here. So I'll lay out a couple of those facts. There's 3 reasons, and that's why we have the subpoints there on the slide, why the question is phrased the way it is. And the first one has to do with private equity funds. So in the world of buyers, there are 2 types. There are financial buyers that are defined as organizations that have money that they need to put to work. And there are strategic buyers, and what separates them is they also have money, but they have operations, and they want to use their money to increase or expand or improve upon their operations. So strategic and financial. And in the world of financial buyers, the by far dominant player are private equity funds. So private equity funds are usually an assemblage of 4 to 10, although some of them have gotten much larger now, kind of hopefully really smart individuals that know how to manage money, know how to make investment decisions, know how to investigate and value businesses, and know how to grow businesses. And they provide a little bit of the money, but they have limited partners or passive investors that provide the vast majority of the money they're looking to spend on acquiring businesses. And those passive investors tend to be insurance companies, pension funds, high net worth individuals. And so what we're talking about here is the amount of money that these private equity funds have to spend presently. About 30 years ago, the first big M&A deal broke on the scene is the RGR Nabisco hostile takeover, made famous by a great book, Barbarians at the Gate, and a horrible movie by the same title that came afterwards. But that deal, the most common commentary in the press was, is there enough money in the entire United States floating around to actually do this acquisition? Because the acquisition was $25 billion was the price that had to be paid. So there was doubt over whether all of the investable money for something like this, like a private equity deal, was $25 billion. And so at the conference that I mentioned earlier, the ACG conference in Las Vegas, the common number that was being kicked around is the amount of money that's out there in the hands of private equity right now was $1 trillion. And they used a horrible cliche, $1 trillion of dry powder, which everyone has really come to hate that term, but it kind of speaks for itself. That's an unusually large amount of money. People do not think that that's going to remain constant and increase. They think it's an abnormally large amount of money. And there's kind of 3 reasons why that amount of money is so high, and I think it's worth going into those. I'll start with the most obvious reason and then get into two lesser reasons. The first one is low interest rates. So because interest rates are low, or because the typical buyer in this market will invest or make their purchase with 60% using their own money, so that equity that's been brought in by these insurance companies, high net worth individuals. So that's the equity portion of their investment. But then they'll go out and borrow 40% of the purchase price. And when interest rates are low, historically low as they are now, have been for a number of years, that debt piece is really cheap. So if you take, for example, a $10 million acquisition, and you assume 40% of that's going to be financed with debt, and we're seeing acquirers now getting 5% interest on that, whereas the more traditional number would be 8 to 10% interest. The length of the loans varies, but 10 years is a decent estimate of the length of the loan. Well, if they can save, up to 5% interest on a $4 million loan over 10 years, that's an extra $2 million they have of cash flow. And they can share some of that cash flow with the seller. They're never going to share all of it, unfortunately. But it gives them a lot more ammunition to play with, and it allows them to borrow more than they might otherwise be interested in borrowing, which means that the equity investment becomes more valuable because it's leveraged against really cheap debt. So that encourages more people to put money into the equity side of the private equity equation and swells the amount of dry powder that the private equity funds have. Obviously, if interest rates go up, the cost of the loans go up, the prices that the acquirers are willing to pay goes down, and perhaps most importantly, the benefit that the equity portion of their investment derives goes down as well, because the leverage effect isn't as strong. So that's the first and the most obvious benefit that we get from lower interest rates and swelling of private equity funds. The second one, a bit less obvious, those insurance companies and pension funds and high net worth individuals that I mentioned earlier that provide the equity into the private equity funds, those groups and those individuals would typically invest in bonds or government securities. And when they look out and they see the best they can get in a government security is only slightly better than inflation, they're a bit distressed. They have to have a return on the money, particularly pension funds, insurance companies. They're eventually going to have to pay out claims. And so their whole model only works if the money they take in premiums goes up in value. So they must put the money to work. The traditional avenues aren't putting the money to work at low interest rates. So these types of investors who have not traditionally been large players in the private equity funds have been forced into contributing to this $1 trillion war chest of the private equity funds. So what happens if interest rates go back up? Well, when interest rates go back up, the expectation would be that these investors would pull their money out of private equity, or at least stop putting new money into private equity. So as the $1 trillion is spent out, businesses are acquired, there's not nearly as much new cash flow coming into the private equity funds. So that's the second reason why low interest rates are increasing the supply of money and the demand for businesses. The third reason is a little less obvious, even than the second one. And you have to think about these financial buyers, these private equity funds. They are generally not buying businesses to hold them forever. They plan to buy them and then resell them in 5, 7, maybe 10 years down the road, typically. And so part of the way they decide their valuation of what they can pay for a business is based upon what they think they can get when they sell. So if they are looking at their potential sale price 5, 7, 10 years down the road, they're going to be thinking about what interest rates are going to look like then, just like we're suggesting you should be looking at what interest rates look like at the time of your potential exit. So you have to not only think about what the interest rates are now, but also what types of interest rates will your buyer be forecasting 5 to 10 years after they make their acquisition, right? Because if they're seeing higher interest rates when they make their exit, then they're going to be forced to pay a little bit less up front because they're probably going to get a little bit less when they resell down the road. The last thing that I'll say there let's move on. We spent enough time on that. I think you get the idea. Interest rates are very important to the supply of money, particularly with the financial buyers, although that leveraging of debt applies to the structural or strategic buyers as well as the financial buyers. But we'll drop down to the second subpoint there, flip over to the cash on the corporate balance sheet. So here we're not talking about financial buyers, we're talking about the strategic buyers, right? So you see Apple has $60 billion of cash. Microsoft has $40 billion of cash. Either one of those companies and another handful of businesses, could do that RJR Nabisco deal entirely in cash, right off their balance sheet. They wouldn't even have to borrow money nowadays to give you kind of an, obviously there's inflation over 30 years, but to give you an idea of how abnormally large these amounts of cash are. Why are the balance sheets so heavy with cash? Well, the businesses are profitable, they make money, they have to find something to do with it. They're not buying back their stock because the stock market is trading at a fairly high level, so they don't view their stock as underinvested. It's not a good investment. What a business would typically do then is plow that money back into the business. They would find organic or inside opportunities for growth, and they would enter new divisions, enter new fields, create new divisions, and basically build new products. And we just haven't seen these businesses, and it's not just tech businesses, but across the board, for the last 10 years, large businesses have been profitable, but they haven't know what to do with the profits, so they've been sitting there on the balance sheet. And at some point in time, they need to do something with the cash. They also need to keep their growth moving. And I'm sure if you read Wall Street Journal or any financial press, this has been a very unusual recovery in that businesses have been growing more slowly than they traditionally grow coming out of a recovery. They're going to have to find some way to speed that growth up. And when you can't build it, what you do is you go out and buy it. So there's a potential when there's this extra cash on the balance sheet, it will start pouring out and be used for acquisitions. And yes, we've seen some of that recently, but the balance sheet numbers are still phenomenally high when you look at the cash of these potential acquirers. So second reason why the supply of money is probably abnormally high. Now, you may think that private equity funds are going to get bigger and that corporations will have more cash on their balance sheet in the future. The conventional wisdom there is that both those numbers are artificially high. So I've jumped ahead a bit, and I've talked about the last point there, the cheap debt financing. So that's your third question. Do I think there will ever be a greater supply of money to buy businesses than there is right now? And of course, that's very closely tied to, do I think interest rates will go up or down, or stay the same? Okay. So we'll move on to our fourth question, lack of growth opportunities. And I think I jumped ahead a bit on this, and I talked about how internally the businesses have not had organic growth opportunities, and they've had that decade of lower than normal growth. So again, the question to ask yourself is, do I think businesses are going to find a way to grow themselves, or do I think they're going to start using that cash to go out and acquire businesses because they can't find enough ways to grow internally? To kind of sum that up, there's the economics 101 graph there, right? On the y-axis, we have the price or the multiples that can be achieved or should be expected to be achieved in a sale. On the x-axis, we have the number of sales happening. Then we have the purple supply line. Supply goes up as multiples or prices go up. And the demand curve in gray, demand goes down as price goes up. And of course, the purple dot in the center is the equilibrium point. That's the expected quantity of sales and the expected multiple to be achieved. But because we're talking to business owners here, you probably don't care about the quantity of sales. If there are 1 million businesses sold, but yours is not one of them, it's not relevant. So another way you can think about the x-axis is that it represents the probability of a successful exit. Again, as you move to the right, the probability goes up, and to the left, of course, it goes down, just like the quantity would. So what we have here is two demand curves. So we have the normal demand curve and that same equilibrium point, which has been labeled 1 here. And based on what we've talked about in terms of the supply of money, it's a fairly wide-held consensus that demand curve has shifted to the right. And so you see when it shifts to the right there, the new equilibrium moves to 0.2, and the result is that multiples have gone up, and the probability of success has gone up. Two great outcomes for business sellers. When we look at supply, and given going back to the demographics and the hangover, we would anticipate, you don't have to agree, but we would anticipate that that supply will increase also. Increasing means moving to the right. So the equilibrium point in the near term, we would expect to move from 2, where it is now, to 3 if we just look at those supply forces. And the result of that is that your probability of success goes up, but it comes at a cost, and the cost is the price that you would be able to achieve. Now, this is the final, I promise, the final chart here today, but if you add on an expectation that the abnormally large demand for businesses will revert to the norm, so we go from that demand curve that pushed to the right back to the original demand curve. So if we're, again, still sitting at number 2 at present, our number 3 equilibrium, our future equilibrium, shifts to where it is here. And the result there is that we see a decrease in both the probability of success and the anticipated multiples that can be achieved. So again, you don't have to agree with our movement of the supply and demands. These are questions for yourself to ask. We just show this to give you a framework to think about these issues, as well as give you our own thoughts on it, but you should come to your own conclusions on those. And think about, again, those external things, the external factors, these are things that you can't control. And that takes us into the easier part of our discussion, which is the internal factors, or the second of those 3 pieces of the puzzle that we had on the first slide there. And the first of these internal factors is how rational are my thoughts about the potential growth of my business. Right? So overwhelmingly, the number 1 reason why business owners don't sell their businesses immediately is because they believe the business will grow. I would imagine most of you who are watching the call have been correct about that for many, many years in a row. And your businesses have grown, and that's a great thing. But we want to make sure you're thinking about the growth correctly. So that's why I said the question is, am I valuing the potential growth of the business correctly? So this predisposition to growth is what's called an intellectual bias. And in the field of behavior finance, it's you know, study after study shows that people are overly optimistic about the value of a stock going up. They're not entirely rational on their probabilities there. And so that's one of the 2 factors that's at work. And another is inertia. So if you've been a successful business owner, you've enjoyed more years of success than failure. You've enjoyed probably some substantial growth. And we all have a tendency to believe in the immutable law of inertia, right? That an object in motion will continue in motion. So if the trajectory is this, we assume the trajectory is going to continue to be that. So you really have to get past those intellectual biases and make sure when you're looking at the growth going forward, you are, you know, being as rational as possible. And a couple of things to help you with that are to think about the cost of the growth. It's very hard to achieve growth without laying out some expenditures in advance, as well as incurring some additional expenditures going forward to support that growth that you've achieved. And secondly, on this issue, you have to think about the growth as expected value. Right? So if you look at a project and you say this project will add $1 million to my bottom line, well, you can't say that with certainty. You have to say there's an 80% probability that it will add $1 million, or 90% probability, or 40% probability. There's always some probability, and you have to multiply that probability times the anticipated value. And that's how you derive expected value. Expected value is the anticipated value, that $1 million on the bottom line, multiplied by the probability of achieving the $1 million. And so if we think about the equation when we're looking at launching a new business, a new plan for the business, or we're thinking about how much will the business grow before I'm ready to sell the business, you have to look at the probability of the growth and compare that to the probability of investment, right? So in the simplest light, you're looking at if I spend $100,000, I can make $1 million. And what we're saying here is you have to say, if I multiply the probability of spending $1 million, which, sorry, 100,000, which if I spend it, the probability is 1. It's 1 times 100,000. Is that going to be more or less than the probability of making $1 million times the $1 million, right? So that's the equation that we start to build on the bottom of the slide there. So again, going back to that the basic equation, if you were going to try to make $2 and you knew it was going to cost you $1, you might be tempted to say, obviously, we're going to do that because the quantity of the growth is larger than the quantity of the expense. But what I've just said here is you have to also look at the probability, and the probability of the expense, or PE, is large because if you do it, it's 1. And the probability of the growth is relative to the other probability, a smaller probability. So when you look at the equation of growth, to understand it rationally, you have to multiply the probability of growth times the amount of growth. And is that more or less than the probability of the expense times the amount of the expense? And that's, go back there for a second. And so that's really the first thing we're talking about. Make sure you're factoring in probability when you're forming your internal expectations about growth. And it leads to our second factor here, which is we find that a lot of our clients underestimate the cost of growth. They're very good at anticipating, I have 2 salespeople, if I hire 4 more, it'll lead to this much growth. So they know what it costs to acquire 4 salespeople or to add 4 salespeople. But what they don't tend to think of oftentimes is if I take my sales department from 2 to 6, I'm also going to have to hire a sales manager. So there's additional overhead. Or a lot of times we have clients that have maybe outgrown some of their software systems, and they come in and they say, yeah, so I'm thinking about putting in a new software system, and this is what it costs to install it, and this is what it costs on an annual basis going forward. And they can map that out. But oftentimes what they overlook is that the new software is also going to require new hardware. It's going to require new infrastructure, perhaps. And if it's sophisticated enough, it may actually require a new hire. And so they leave that out. Similarly, my third example there, opening a new branch. So we've seen very detailed plans of what it would cost to open a, say, 4th branch of the business or a 4th sales location. But what we don't see in those equations is, if I have several people in my headquarters and one of them is fully occupied doing whatever they do for the 3 satellite offices, and when I add a 4th satellite office, that person's workload is going to go up by 33%. And does that mean I'm going to have to hire another person? I'm going to have to pay them more? Am I going to have to pay them more overtime? They leave those type of things out of the equation. So this is the second question when you're looking at your growth going forward, is have I correctly captured all of the potential costs associated with that growth? That leads us to our third and final point on the internal factors, is the general downside risk. Again, I had mentioned that we all tend to be overly optimistic about a lot of things, but in addition to that, there's another irrationality that we all have, which is that human beings do not process small risks correctly, or as an economist or a behavioral financial person would say, they don't measure small risk rationally. They tend to greatly underemphasize small risks and not understand the magnitude of that risk. And it's interesting, there was an article in Wired magazine many years ago now that talked about this. And so the way that animals perceive risk is in the amygdala, which is kind of down by the brainstem. It's one of the oldest parts of the brain. And all animals have this thing, and it's what generates the fight or flight instinct. It's what tells the body to pump out adrenaline, right? And so that's one way that all animals judge risk. And due to survival of the fittest and whatnot, lions are pretty good at assessing the risk they face, and lizards are pretty good at assessing the risk that they face using that amygdala, that flight or fight response. But in mammals, we have something that's been around for a shorter amount of time, maybe a million years, less than 10 million or whatever, and that's called the neocortex. And the neocortex is a second place that also analyzes risks, but it doesn't do it with adrenaline, and it doesn't do it with the flight or fright. So the fight or flight is more of an emotional reaction, whereas the neocortex is more of an intellectual reaction. It's where it calculates risks and assigns probabilities and things like that. And so whenever, and only mammals, by the way, have this part of the brain. And so when a mammal, and particularly humans, face a risk, they're getting 2 sets of inputs into their decision-making process. They're getting the emotional or the gut reaction, and they're also getting the analytic reaction. And so for very large issues, such as an oncoming car, the amygdala is going to kick in and take over. And then for medium-sized responses, you get a fight between the two. And in our life, when we spend a lot of time thinking about risk, we get pretty good at that stuff in the middle. We get pretty good at balancing out those two parts of the brain. But when it comes to smaller risk, what this Wired article said was the amygdala doesn't engage on a very low percentage risk. So there's absolutely no adrenaline that gets involved in the equation. And this is why, when you're walking down if you were walking on the edge of the cliff, you'd be very alert and you wouldn't stumble and fall off the cliff. But sometimes you walk on the sidewalk and you stumble over a crack in the pavement because you just don't look at the low risks at all, because the consequence of a tripping on a sidewalk is probably not that high. So the amygdala doesn't kick in. So these very low probability risks, those get delegated entirely to the neocortex. And the neocortex isn't used to working on its own. It does a lot of other things. And without the adrenaline hitting it and telling it to calculate risk correctly, it kind of just ignores it. And so this word map that we have on the screen here, these are all low probability risks. The chance of any one of these things happening to you between now and the time you exit the business is probably pretty low. You probably don't need to worry about any one of these particular things. However, if they're all, say, half a percentage chance of occurring and there's 20 of them or 50 of them, it starts to become a material risk when you pile them all up. But, and this goes to what I mentioned earlier, the predisposition to assume continued growth. Our brains are not good at taking all these little tiny risks and putting them together and saying, as a whole, these represent something I need to be thinking about in my decision. So incidentally, every one of these words up here, we came up with these by looking back at our clients over the last few years, and every one of these has literally happened to one of our clients. Not while they were waiting to sell, but unfortunately at a more severe point, which is while we were engaged in the sale process. So these, although they're micro probabilities, they do happen. So that's the internal factor number 3. And just to kind of close that out, that formula I showed earlier, right? So some of you like formulas, some of you don't. So if you don't, just tune out for a minute. But what we have there is trying to figure out what's greater on this chart. Probability of growth times the anticipated amount of growth minus the probability of one of those bad things happening times the effect of the bad thing happening plus the second bad thing times the third bad thing, and it continues on. Is that greater or less than the probability of the expense you're going to outlay to get that growth times times the sum of the expense of the growth, both the direct or obvious expenses as well as the hidden or indirect expenses. So some people the formula resonates, for some people it doesn't, that's fine. But that takes us into our third and final area, which are the family factors. And here by family factors, we mean individual factors or personal factors. We could have called them any of those 3 options. So we have 3 of these, and the first one is the purpose. So you should always be asking yourself, why do I own this business? And a good way to do this is to take a piece of paper and divide it into 3. On the first side, on the first third, write down all the reasons presently that you own the business. In the middle, put down all the reasons that you used to run the business, or perhaps why you started the business. That second column is going to be important just to make sure you don't put legacy items in that first column. Okay? And then the third column, put in the benefits of not owning the business. Yeah? And what you're going to do is compare the first column to the third column. So everything that we've talked about up to this point has been financially related. We've been talking about money. But selling a business is never exclusively about the money. It's a very emotional process. It's a very personal process. Eric Benchmark, we know that. We've set up our entire model to work around that reality. Unfortunately, buyers don't always realize that. And part of what we try to do is get the buyers to understand that as early in the process, as well as being supportive of the sellers going through it. So in thinking about this timing issue, our first question here is, am I properly considering all of the non-financial aspects of the decision. And we kind of think this: why do you run the business, and what do you do with the money it provides? Are kind of two good ways to think about that first question. Second factor in the family category. A lot of different ways to say it, but how much money do you need? So a lot of times we talk to business owners who aren't ready to sell. One of the things they say is, I can't sell yet because the amount of money I would get would not satisfy what I need for the rest of my life and whatever my other personal objectives are between now and the end. So business owners, in our experience, are typically not followers of modern portfolio theory. So modern portfolio theory says the best thing you can do with your assets or your money is to put it in a well-diversified portfolio of assets that bear little or no correlation to one another. So in other words, a well-diversified stock and bond portfolio is kind of a simpler way to say that. But our business owners that we deal with, that's not what they've done. When they get excess money, they do one of two things with it. They either plow it back into the business or they spend it. And they, as a result, they don't have that well-diversified collection of assets. They are concentrating their risk in one single asset. And they're very comfortable with that. That's why they do it. It's served them very well. And it might well serve them very well for time to come. But if you're in the process of selling the business, you're going to have a new strategy after that, because whatever comes next, you're not going to have the same degree of control over it. And I think the reason that business owners are successful business owners are comfortable putting all their eggs in one basket is because they feel they have very firm control of that basket. Well, after the sale, you won't have firm control of the basket. So you need the protections of this modern portfolio theory. So our question here is, we phrase it as how much do you need, but what the real question is do I fully understand my needs and how my finances will work after the sale? And given the advice that we provide to almost all of our clients after we get to know them is that they probably really need a wealth manager. They haven't typically worked with wealth managers in the past because they know what to do with their wealth, reinvest it in the business. But after the sale, your in total financial picture is greatly changed. And wealth managers are more than happy to come and talk to you. A lot of our clients say, well, I never spoke to one because I don't have any money to invest with them. Well, the way wealth managers work, if you don't know, is they're more than happy to come and sit with you and talk with you multiple times before you have the money. You may have a relationship 2, 3, 4, 5 years with a wealth manager where you don't have anything to invest with them. And they know that, and that's fine. That's how their business works. They will continue to deal with you because they know you do have a business. They know eventually you will exit the business, and you might want their assistance. So as part of this equation, you should, even if for you a sale is many, many years down the road, you should start reaching out to wealth managers and start learning from them what your life will be like after a sale. Some of them, particularly as the time for sale draws near, have very good models where they'll ask you a lot of questions about your lifestyle, your family planning issues, and they'll be able to kind of calculate out and chart out for you very well what you need or what you will need, and then also the type of returns you'll be able to make on your investments from a sale. A lot of clients we talk to say, well, I sell my business, I end up with $10 million after the sale. My partners get their chunk and the fees and the taxes and everything. I have $10 million. I can't live on that. And they're making an assumption about the kind of return they're going to get on that type of money. And if you read Money Magazine and you have the kind of money to invest if people read Money Magazine, then that might be tough. But when you have 7, 8 figures of cash, the returns that you can get, the opportunities that you're exposed to are extremely different. And unless you've been operating in that world, it's pretty hard to conceive of the potential return you get unless you go talk to a wealth manager. So we're not wealth managers. We're not tied in with wealth managers. It doesn't matter which one you go to. Find a good one and get in there and start talking so that you can correctly ask yourself this question about your post-sale life and finances. That brings us to our 10th and final point, which is time. It's a kind of an old adage that new business owners, when they start a business, and then whether they consider the business profitable or not, they basically work for free for a few years, and they don't count the cost of their own time in that in their profitability calculations. Hopefully you're all well past that stage, and you've been taking nice salaries, bonuses, and distributions from your business. But I think there's still that tendency there to forget to think about your time. Yeah. So we started off and talked kind of through 7 or 8 issues that related to money, and then we talked about kind of post life finances and priorities. But now this is really strictly about your time as a business owner. You know, how much time are you spending in the business right now? What is that time worth to you? What would you be using that time for if you weren't using it on the business? I said my last point there. What would it be worth to you if you weren't working in the business? What would you be doing with that time? Yeah, so think about time. So the question here is, how does my intention to use my time play into my decision? Yeah, and kind of one bullet point on that at the bottom here is that it's very rare for a middle market or lower market business that's owner operated. So if you're an owner operated, it applies to you. If you're not, then it doesn't. But most of the businesses are owner operated. The issue there is, how long am I going to have to stay on after the sale? And general rule of thumb is 6 months to 2 years. Every business is different. Every industry is different. It's going to come down to a number of considerations, including what your current role is in the business, how good your second level of management is, how well you've developed processes and systems, which important relationships you manage, who can be the visionary for the company if you're not there, and do you have your clients locked up with long-term relationships, or is it just based on relationships in general? So a number of things, and those are all things that you might be able to kind of tweak in your business. But one thing is, it also depends on the type of buyer, right? So a financial buyer comes in, they don't know how to make widgets or sell widgets or distribute widgets or service widgets. So they're going to want a steady hand on the helm there for a longer period of time. Whereas if it's a competitor that comes in and buys your business, they might not be as interested or feel it as necessary to have you around because they know how to do what you do. They're already doing it. So you can never fully answer that question in advance. But when you're thinking about the timing, you probably need to be thinking 6 months to 2 years after the deal closes, still be giving my time to that business. Of course, you'll be compensated for it and everything. You're not giving it away for free, but that time commitment will probably still be there. So I think we have just about 10 minutes left. Oh, sorry, one last slide. Just to recap the 3 questions there. I think I'll just let you read that for a second. I've already said it enough times over. And now with 10 minutes left, that takes us into the questions. So I have Sam here, who's been collecting the questions as we've gone along. What do you have, Sam?
Okay. First question, I did get a few during the presentation that would be good addressed to the group. First one came from David. He said, once I decide it's time to exit, how long will it take?
Oh, that's a good question. That kind of could have been on the last slide. It's every transaction is different. Every business is different. It's going to take a minimum, say 6 months, and sometimes it can take longer. So some of the things that depends on are the owner's expectations. There are some business owners who always believe a better deal is around the corner, and they take the process and cause the process to go on a little bit longer than it might otherwise. But I think probably the main answer to that question depends on who's in control of the sale. So if you think through these questions and you control the timing of going to sale, you can generally do it faster and still get the desired result, as opposed to you not controlling the process and something comes up and you've got to sell. In order to get a good result, that actually ends up taking longer. So 6 months to a year, ballpark plan. Depends on how realistic your expectations are. Then obviously it depends on different industries move a little faster than others. Different businesses within an industry will move a little different than others. But yeah, definitely you need to add that chunk of time into your timeline.
Okay. Next question comes from Lee. He asks, what are some of the pros and cons regarding selling to a PE firm versus a competitor or business in your industry?
Sure. So let's see. Let's start with the pros of a private equity fund over a trade buyer. The private equity funds, they have to put money to work. They're on a schedule. They've got committed funds from these limited partners, but they've got to deploy them quickly. So they tend to move through the process. And their job is to spend money, to invest money. But their job is to buy businesses. Whereas a trade buyer, they have a lot of competing priorities. So you get involved with a private equity fund, they can't afford to waste time and mess around. The way their fee structures work internally, they got to move, and they got to keep moving through the deals. So they tend to have better trained personnel involved, so they can be a little more efficient, and they tend to feel the pace of the clock running a little bit, so they move faster. There's an old debate about who pays more, and I don't think there is a correct answer to that. I think private equity funds, another advantage to financial buyers, private equity funds, is they're probably going to offer more structuring opportunities in the transaction, which is a good thing and a bad thing, right? Because structuring generally means the seller's not going to get as much money on the closing date. It might be spread out. But the good news is, if the negotiations go well, as a result of the structuring, you can end up getting a lot more money. So the financial buyers are more into they don't see it as much as a zero-sum game, and they're trying to make a win-win solution. So they can offer a lot more money if they can have a little more time to pay it, because they have to measure their returns to their investors only for the amount of time they have the money invested. So if they can invest some of that money a little bit later, they have to give less money out the backside. So they'll be more creative and a little more generous on the structuring, which will oftentimes help get the deal closed. Flipping over to the trade buyers are a little less interested in structuring. So the good side there is you tend to get a little more cash, a higher percentage of your cash at close as opposed to over time. Bad side is they're less flexible on structuring a deal that's win-win. They tend to see things a little bit more as a zero-sum game. So it's a little bit harder to get those deals closed. So that has the plus and minus of both sides. Plus side with trade buyers, they know the industry. So a lot of times the financial people will come in and they'll have some experts that help them, and they'll know something about the industry, but they don't know as much as a strategic buyer typically would know. So with a strategic buyer, they'll do a little bit less due diligence typically, and they'll be able to cut some corners because they can get comfortable with the business faster. So whereas it might take them longer to get through the negotiation, the drafting of the documents, you kind of make up for that by having the diligence go a bit faster and just a little bit less painful on that side. So those are the major differences.
Very good. Okay. Third question came from Roger. He asks, what about exchange rates? Do they affect the supply and demand discussion?
Yeah, so this goes back to our first puzzle piece on the top, the external factors. Strong dollar, weak dollar, does that affect foreign inflows of capital? Two things there. One is nobody ever agrees on whether exchange rates are going to go up or down. And two, the exchange rate isn't as important as the concept of the United States as a safe harbor. So while the exchange rates going up and down has some effects, the bigger effect is as more turmoil arises around the world, money looks for safe havens, and the United States is kind of the ultimate safe haven. So going back to thinking about the timing, so this is kind of on that demand side, you could add another question down there. Do I think the world will get a little more chaotic or a little less chaotic? Because if it gets more chaotic, the demand for U.S. businesses will go up because money will flow to the United States. If the rest of the world calms down and everything is going nicely and there's not a lot of risk, then money will go chase higher returns in other countries, and there'll be less demand for U.S. businesses. So it really has to do with kind of the overall state of war and peace more than the exchange rates. Because exchange rates in reality don't really move that much. most times between the major currencies of the world, and they kind of tend to revert to the norm over time. So exchange rate is not really doesn't really affect the supply and demand curve that much. In the short term, if there's a weak dollar, a foreign buyer may be able to pay a little bit more than a U.S. competitor for the business, and if there's a strong dollar, the foreign buyers are going to be priced out of some of the competitions for businesses.
Okay. Next comes from Rogers. He asked, is there a general rule of thumb for evaluating a business?
Yeah. So if you go to business school, there's 3 ways to value a business. Discounted cash flow, comparative trading prices, you look at publicly traded companies and discount them down, or comparable transactions. So you look at the last 5 deals in the space and see what the multiple was and use that for you. And that's great for business school because business schools love to deal with lots of data, and for publicly traded companies, there's lots of data. For middle market businesses and lower middle market businesses, there's not a lot of data. So there are agencies that purport to put out multiples and trends, but all the information is self-reported, and it's not self-reported to the Securities and Exchange Commission. So people aren't necessarily standing behind it, and one man's 8 times might be another man's 6 times multiple. So these things that you learn in business school are by and large useless for valuing businesses, privately held, owner-operated, middle market, lower middle market businesses. It goes back to the other way to value businesses, what a willing seller and a willing buyer will agree to pay in an arm's length transaction with the absence of duress. So you never really know the value of a business until it's time to sell. So when deals are happening, the common language, and it's almost like India where there's 23 dialects, and if you travel from one end to the other end of the country and you want to talk to someone, you speak English. But that's not what they speak when they go inside their own family. Same kind of thing as this concept of multiples, is the lingua franca of the M&A world. So when the buyer and the seller sit across the table from each other, they talk about multiples of EBITDA, and that's usually the EBITDA for the last 12 months leading up to the discussion, or the trailing 12 months EBITDA. And they'll put a number on that. So it'll be an equation with 2 variables, a number, which is the multiple, and the 12 months of EBITDA. Now, that's how the discussions go back and forth. But in reality, when the buyer goes back and they're in the family, they're going to talk about it for some other reason. They have some other way to value it, most likely. Similarly, when the seller side, when your side goes back and talks about it with the family, you're not going to say, I always wanted to sell a business for 10 times, and I got 10 times. I'm so happy, right? That's not how you're valuing your business. You're valuing it because by selling it, you need to satisfy some need. Or by selling it, you think you can get the maximum value that will show up, and this might be the maximum value. People aren't going to turn down a deal because it's 9.9 times instead of 10 times, or 7.8 instead of 8.0. They're going to turn it down because there's not enough cash in it at the end of the day, or they don't like the deal. So valuation's a very complex thing in the middle markets, the lower middle markets, primarily due to the absence of data. So you can make some rough comparisons, you can get some ballparks. Every business is unique. It's not like selling real estate, which unfortunately a lot of people think it is. It's more like selling art, right? So the last Matisse sold for $12 million. What's the next Matisse going to sell worth? Well, I can't say just because the last 4 Matisse all sold for $12 million that I think the new one's going to sell for $12 million. Right? Who knows? It could be a more famous piece, or a prettier piece, or a bigger or smaller piece, or something that one crazy collector from somewhere in the world just has to have, and they'll outbid everyone else. So every business is unique, and every business has a unique value. So that's the hard part of the lower middle markets and middle markets, is valuation piece.
Okay, I do have a few more here. So next one comes from Dennis. He asks, is it better to have more funds in the bank or less? And is this what you meant by buying cash?
For the seller, I assume we're talking about the seller. So when these deals are structured, what the buyer's actually buying is the equity value of the business. So if they say the value of the business at $50 million, they're saying $50 million assuming it has no debt and assuming it has no cash. So the deals are almost always debt-free, cash-free. So the amount of cash the business has in the bank on the closing date or leading up to the closing date is largely irrelevant because all the buyers are assuming the seller is going to keep all that cash. So the amount of cash on the seller's balance sheet doesn't really matter. You know, you have to leave a little bit of cash in, like if you're running a diner, to use a simple example. You gotta when you open on Monday morning, you gotta have some ones and fives and tens and quarters and dimes in the cash register. So you gotta leave that cash in. But by and large, the cash belongs to the seller and it's totally irrelevant to the transaction.
Okay. Next one comes from Patrick. Yes, if EBITDA for the trailing 12 months has a reason for being different than previous, how difficult is it to compel a buyer to look at the historical performance instead of the most recent 12 months, which is abnormally low?
Oh, yeah, two answers to that. So an easy thing to do is to say, well, let's use a trailing 3 years instead of the trailing month, and you give them the reason why. And if what you have to do there is you have to convince the buyer that the reason that it was low in the first half of 2017 is not going to be continued going forward. What's more likely to continue going forward is the good 2016 number, the good 2015 number behind us. So there's a story piece of it, but mathematically, the first line of attack is just to say, let's use 3 years instead of 1 year. The more sophisticated approach and the better one for the seller is to do what's called an add back. So suppose that the business had a lawsuit, the first one in their 25-year history, and they spent $500,000 on an attorney. And that's why their EBITDA is $500,000 below what it had been historically. So what you do is in the process of marketing the business, you tell the story of that one-time cost, and you establish it's not a recurring cost. Whatever happened here is not going to happen again. And therefore, my true EBITDA or my adjusted EBITDA or my normalized EBITDA for trailing 12 months was this higher number that's consistent or slightly above the old numbers. It's not this artificially low number. And how well you can make that case determines on the credit you'll get for that, what we call that an add back, that say $500,000 for the attorney. And almost every business that goes to market has add backs. There's one-time events or even recurring events that are discretionary, and the buyer won't be incurring those costs. So sometimes, a lot of the kind of personal things that owner-operators have in the business, buyer's not going to have those. So all those costs get added back. So that there's a whole real art and science to maximizing the add backs. You have to find them, and then you have to provide a convincing story for them as to why they should be given full credit. If the reason the EBITDA dropped was because you lost your best customer, that was 25% of your business, then you're going to have to go for, hey, let's use the average of the last 3 years. But if the reason that happened was, say, a lawsuit or supplier went bankrupt and it took you 6 months to find a new supplier, those are the easier form of add backs.
Okay. Well, I do have one more question here, which is probably all we have time for. Is it's right that benchmark, company literature seems to indicate higher rates of returns for international buyers. Is that still the case currently, or are there any updates on those trends?
Yeah, no. So the foreign buyers are harder to get, harder to reach out to, but they do like to pay. Well, they don't like to. Nobody likes to, but they do tend to pay a premium. That is true. If they're going to go and do a transaction all the way overseas, it's not that they're kind of stupid and they don't know. But it's more that they tend to be, particularly for this size companies, they tend to be making their first foray. They're planting the flag in the United States, which is a massive market. By some definitions, it's still the largest market, depending on what you call the EU. And so they want to plant that flag, and they want to plant it, firmly. And they want to come in, and they want to make sure that they're getting a quality business. They're going to, the distance or the cultural difference, they know it's going to make them a little bit harder for them to administer the business. So again, they'll probably want the owner to stay on a little bit longer than a domestic buyer would, but they want everybody to be happy. They don't want to come in and buy a company where the employees feel that their owner got fleeced, that the employer is still around, he is not happy about the deal, because they're not going to be just down the street or across the state border. They're going to be on another continent probably, and they want to know everything is running fine. So they don't mind paying that little bit of an excess to make sure that everyone's happy. And then that's one reason. The second reason is, when you find a foreign buyer, and so let's say you go for a domestic buyer. Suppose that you are a company that does direct mailing, right? And your buyer is a company that's direct mailing 50 miles south of you or 100 miles south of you. They might not have been in the market to acquire, but you show up and say, I'm ready to sell. You're a logical buyer. And they say, yeah, sure, I'd like to expand to the north, no problem. So they're not super excited about it, but it's a good idea, and maybe they'll offer a fair price. Whereas if someone's going to come from Germany, or we had a buyer from Sri Lanka this year, actually. A lot of people don't even know where Sri Lanka is, but it's a country south of India. It's an island in the Indian Ocean. If they're going to come all the way from the Indian Ocean to the eastern coast of the United States, they have a mission. They're looking for something, right? And we all know when we're selling something, the best thing you want is an eager buyer. And so almost by definition, someone who's looking across continents to buy is likely more times than not to be more eager than someone just down the street. But so for those two reasons, yeah, that's true, and I don't see that changing ever. I think we're about out of time. Again, if there's anything you want to type in, we'll keep the chat session open for a couple more minutes, and you can type something to Sam, and we'll look to have another one of these sessions about a month from now. And you can see on the slide here Sam's contact information if you want to reach out to him after we're done. You got his email address and his phone number there. And of course, you can follow our company with Facebook, Twitter, LinkedIn, whatever's newer than that. Of course, our website. And thank you all for joining, and we look forward to having you with us next month.